The S&P 500 forward price-to-earnings ratio just crossed above 22 for only the third time since 1985. The first time it happened was the dot-com bubble. The market fell 49%. The second time was during the COVID pandemic. The market fell 25%. We are now in the third time. And Federal Reserve Chair Jerome Powell just publicly warned that stock valuations are fairly highly valued. When you see what happens to your money at these valuation levels, you'll understand why the Fed is nervous. Historical data reveals a pattern most investors have never seen. Every time the PE exceeded 22, investors lost an average of 6% over the next 2 years. Not gained, lost. That means if you invest $100,000 today, history says you'll have $94,000 in 2 years. The question isn't whether stocks are expensive. The question is whether you understand what expensive actually costs you. My name is Alex, and I've spent the last decade tracking market valuations and Federal Reserve policy so you don't have to. I read the FOMC minutes, the financial stability reports, the research from FactSet and Goldman Sachs. I track the data that tells you what's actually happening versus what the headlines want you to believe. If you want to protect your portfolio and understand what these valuation levels mean for your money, make sure to hit that subscribe button and give this video a thumbs up if it helps you see the market more clearly. Before we dive in, I want to know, are you buying stocks right now, holding what you have, or moving to cash? I'm genuinely curious where this audience stands at these valuation levels. Drop your answer in the comments. Here's what I'm going to show you. The market is trading at a valuation level that has only existed twice before in modern history. Both times ended badly. The Federal Reserve is warning about it publicly. The data shows what happens to returns at these levels. And there's a specific mechanism that makes this time particularly dangerous. By the end of this video, you'll understand exactly what a PE ratio of 22 means for your portfolio and what history says happens next. Now, you've probably heard that stocks always go up over time. Buy the dip. Time in the market beats timing the market. Dollar cost average and don't look at your account. That's the standard advice. Here's what nobody tells you about that advice. It's missing the most important variable, starting valuation. Because stocks don't always go up. They go up from cheap levels, they go sideways or down from expensive levels. And right now, according to FactSet research, as of January 2026, the S&P 500 is trading at a forward PE ratio of 22.1. That's a meaningful premium to the 10-year average of 18.8. Let me give you context for what that number actually means. A PE ratio is the price you pay for every dollar of earnings a company generates. If the PE is 22, you're paying $22 for every $1 of annual profit. The higher the PE, the more expensive stocks are relative to what they actually earn. The S&P 500 has only traded above 22 times forward earnings during 2 periods since 1985, the dot-com bubble that peaked in 2000, and the COVID pandemic era that peaked in January 2022. After the dot-com bubble, the S&P 500 eventually fell 49%. After the COVID peak, it fell 25%. We are now back above 22. And this time, there's something different happening that makes it more dangerous. But before I explain what that is, you need to understand what the Federal Reserve is saying right now. Jerome Powell warned in September 2025 that stock valuations are fairly highly valued by many measures. That's Fed speak. When the Fed chair says stocks are fairly highly valued, what he means is they're expensive and we're watching it closely. The October 2025 FOMC minutes went further. Several participants commented on stretched asset valuations. Some highlighted the possibility of a disorderly fall in equity prices. Read that again. Disorderly fall in equity prices. That's the Federal Reserve saying we're concerned about a crash. Fed Governor Lisa Cook said in November 2025, there is an increased likelihood of outsized asset price declines, not small declines, outsized declines. The November Financial Stability Report warned that the S&P 500's forward PE ratio was close to the upper end of its historical range. This is not one person saying stocks are expensive. This is the entire Federal Reserve System telling you they see risk. Now here's where it gets interesting. The Fed doesn't usually warn about stock valuations publicly unless they're genuinely concerned. They prefer to stay quiet and let markets do their thing. When they start talking about it openly, it means they see something that worries them. And when you look at the historical return data, you'll understand why they're worried. When the forward PE exceeds 22, the S&P 500 has returned an average of positive 7% over the next 12 months. That's according to research compiled by Motley Fool and Nasdaq in January 2026. Compare that to the average return of positive 10% for all periods. So in the short term, year one, expensive markets still go up, just not as much. That's why valuation is a terrible short-term timing tool. Stocks can stay expensive and keep going up for months or even a year or two. But here's where the math changes. Over 2 years, the S&P 500 has declined an average of 6% after the forward PE exceeds 22, not gained 6%, declined 6%. Compare that to the average 2-year return of positive 21% for all periods. That's a 27 percentage point difference in outcomes. Let that sink in for a second. At normal valuations, your money grows 21% over 2 years. At expensive valuations, your money shrinks 6% over 2 years. If you invest $100,000 today at these valuation levels, history says you'll have $94,000 in 2 years. You're not building wealth, you're eroding it. And the reason this happens is mathematical. When you pay $22 for $1 of earnings, you need one of two things to happen for your investment to work. Either earnings need to grow fast enough to justify the high price, or the PE ratio needs to go even higher, meaning someone else needs to be willing to pay an even more expensive price than you did. The problem is that PE ratios don't expand forever. They revert to the mean. And when they revert from 22 back down to the historical average of 18.8, the math is brutal. Even if earnings stay flat, the stock price has to fall 14.5% just to get the PE back to average. That's not a crash, that's just normal mean reversion. And if earnings disappoint at the same time the PE contracts, that's when you get the 25 to 49% declines we saw after the last 2 times we were at these levels. Now we're halfway through, and honestly, the most important part is still coming. Because there's a specific reason this time might be worse than the previous 2 times. And it has to do with something called the equity risk premium. The equity risk premium is the extra return you get for taking the risk of owning stocks instead of owning risk-free government bonds. According to Oppenheimer's 2026 market outlook, the S&P 500's forward earnings yield is near parity with the 10-year Treasury. The equity risk premium is just 0.02%. That's among the lowest on record. This is the first time we've seen the equity risk premium this low since the tech bubble burst in 2000. Let me explain what that means in plain English. The 10-year Treasury is considered the risk-free rate. You loan money to the US government for 10 years, they pay you interest, and you get your money back. No risk. Currently, the 10-year Treasury yields around 4.5%. The S&P 500's earnings yield, which is the inverse of the PE ratio, is also around 4.5%. That means you're getting essentially the same return from stocks as you are from bonds. Except stocks can lose 50% of their value, bonds can't. Think about that for a second. You can take zero risk and earn 4.5% in treasuries. Or you can take massive risk and earn 4.5% in stocks. Where's the incentive to own stocks? There isn't one. And when investors figure that out, money flows out of stocks and into bonds. That's what happened in 2000. That's what could happen now. The equity risk premium is supposed to compensate you for the risk of owning stocks. Historically, it's been around 3 to 4 percentage points. You take risk, you get rewarded with higher returns. When that premium shrinks to near zero, you're taking stock market risk but getting essentially no extra reward over risk-free bonds. That's not investing, that's gambling with no edge. Here's the other thing nobody's talking about. The S&P 500 is trading in the 86th percentile of all recorded historical readings. That means the market is more expensive than it was 86% of the time in history. Only 14% of historical periods were more expensive than right now, and most of those periods were in the dot-com bubble or the COVID bubble. You're buying at a valuation level that has only existed during manias. Goldman Sachs expects the S&P 500 to generate just 3% annually over the next decade, not 10%, 3%. That's according to Goldman Sachs research published in January 2026. Dating back to 1990, the S&P 500 has never generated a positive 10-year return when the trailing PE multiple exceeded 25. We're at 22 on a forward basis, which is typically lower than trailing. If the trailing PE is above 25 right now, history says the next 10 years will be flat or negative. Think about what that means for your retirement. If you're 35 years old and investing for the next 30 years, maybe you can wait out a lost decade. If you're 55 years old and planning to retire in 10 years, you don't have time to wait for the market to recover from a flat decade. Starting valuation matters. It might be the thing that matters most. Now let me tie this all together, because when you see how these pieces connect, everything changes. The S&P 500 is at a valuation level that has only existed twice before. Both times ended with sharp declines. The Federal Reserve is publicly warning about stretched valuations and the risk of disorderly declines. Historical data shows that when the PE exceeds 22, two-year returns average -6%. The equity risk premium has collapsed to near zero, meaning you're taking stock market risk for bond market returns. And long-term return expectations from Goldman Sachs are just 3% annually for the next decade. Every single data point is flashing the same warning. Stocks are expensive. Returns from here are likely to be poor. Risk is elevated. But here's the psychological trap most investors fall into. They hear this information and they think, yeah, but this time is different. AI is going to change everything. Earnings are going to grow faster than anyone expects. The market can stay irrational longer than you can stay solvent. And all of that might be true in the short term. Goldman Sachs still forecasts 12% total return for 2026. The Wall Street median target is S&P 500 at 7,600 by year-end, which is 10% upside from the current level around 6,950. AI productivity gains could boost earnings enough to justify current valuations. Valuations are not good short-term timing tools. The correlation between PE ratios and one-year returns is weak. Stocks can absolutely keep going up from here for another 6 to 12 months. But that's not the point. The point is what happens over 2 years, 5 years, 10 years. Because if you're investing for retirement, you're not investing for the next 12 months. You're investing for the next 10 to 30 years. And the data is clear. Starting valuation is the single best predictor of long-term returns. When you buy expensive, you get poor returns. When you buy cheap, you get great returns. Right now, you're buying expensive. So what do you do with this information? I'm not going to tell you to sell everything and go to cash. I'm not going to tell you the market is going to crash tomorrow. I don't know what happens in the next 6 months. Nobody does. But I am going to tell you this. If you're investing new money right now, you need to understand that history says your expected return over the next 2 years is -6%. If you're okay with that risk, fine, keep buying, but go in with your eyes open. If you're close to retirement and you can't afford a 25 to 49% drawdown, you need to think about reducing your equity exposure. Not because I'm predicting a crash, but because the risk reward is terrible right now. You're taking maximum risk for minimal expected return. That's a bad trade. If you're young and investing for 30 years, you have time to ride out a crash and recovery. But even then, dollar cost averaging into an expensive market means you're buying high. You'd be better off waiting for a correction and buying lower. Or at minimum, being more selective about what you buy. Not everything is expensive. There are pockets of value. But the broad index at a PE of 22 is not one of them. The real magic happens in your brain when you separate what you want to be true from what is true. You want stocks to keep going up because you're invested and you want to make money. That's normal. But what's true is that stocks are trading at the third most expensive level in 40 years. What's true is that the last 2 times we were here, the market fell 25 to 49%. What's true is that the Fed is warning about it. What's true is that the equity risk premium has collapsed. Those are facts, not opinions, not predictions. Facts. And here's the hard truth that might sting a little. If you ignore this information because it's uncomfortable, you're not investing. You're hoping. You're hoping this time is different. You're hoping AI saves the market. You're hoping the Fed cuts rates enough to keep the party going. And hope is not a strategy. Hope is what gets you caught holding the bag when the music stops. I know this isn't what you want to hear. You want me to tell you the market is going to 10,000 and everything is fine. But that's not my job. My job is to show you what the data says and let you make an informed decision. The data says stocks are expensive. The data says returns from here are likely to be poor. The data says risk is elevated. What you do with that information is up to you. Now let me show you how all of this works together as a system. The PE ratio tells you how expensive stocks are. The equity risk premium tells you if you're being compensated for that risk. The historical return data tells you what happens at these valuation levels. The Fed warnings tell you that the people with the most information are concerned, and the long-term return forecasts tell you what to expect over the next decade. When all of those inputs point in the same direction, you pay attention. When the PE is at 22 and the equity risk premium is near zero, and historical 2-year returns are -6%, and the Fed is warning about disorderly declines, and Goldman Sachs is forecasting 3% annual returns for a decade, you don't ignore it. You adjust. You reduce risk. You raise cash. You get more selective. You prepare for the possibility that the next 2 years look more like 2000 to 2002 or 2022 than they look like 2023 to 2024. That's not market timing. That's risk management. And risk management is the difference between people who build wealth over decades and people who give it all back in one bad cycle. The investors who survived 2000 and 2008 weren't the ones who were the most bullish. They were the ones who respected valuation. They were the ones who understood that expensive markets don't stay expensive forever. They were the ones who were willing to sit in cash or bonds when stocks offered poor risk-reward. And they were the ones who had money to invest when stocks got cheap again. You're not going to get rich buying stocks at a PE of 22. You might make money for a few months. You might even make money for a year. But over 2 years, history says you lose money. And over 10 years, history says you make 3% annually, which barely keeps up with inflation. That's not wealth building. That's wealth preservation at best. And it's wealth erosion if inflation runs hotter than 3%. The S&P 500 at a PE of 22 is telling you that the market has priced in a best-case scenario. Earnings have to grow. The economy has to stay strong. The Fed has to cut rates. AI has to deliver productivity gains. Everything has to go right. And if everything goes right, you make 3% a year for a decade. If anything goes wrong, you lose money. That's the trade you're making when you buy at these levels. So here's what I want you to take away from this. The market is expensive by historical standards. The Fed is warning about it. The data shows poor expected returns. The equity risk premium has collapsed, and you are paying $22 for every $1 of earnings. That is a fact. What you do with that fact is your decision. But make it an informed decision. Don't buy because you're afraid of missing out. Don't buy because everyone else is buying. Don't buy because some talking head on TV said stocks always go up. Buy because you understand the risk, you understand the expected return, and you've decided the trade is worth it. Or don't buy because you understand the risk and you've decided it's not worth it. Either way, make the decision based on data, not emotion, not hope, not fear of missing out. Data. The people who build real wealth in the stock market aren't the ones who are always bullish. They're the ones who know when to be aggressive and when to be cautious. And right now, with the PE at 22, the equity risk premium near zero, and the Fed warning about disorderly declines, this is a time to be cautious. Your future self, the one looking back on this moment 10 years from now, is going to judge you based on the decisions you make today. If you buy at a PE of 22 and spend the next decade earning 3% annually while inflation eats away your purchasing power, your future self is going to wish you had been more careful. If you reduce risk now, raise some cash, and wait for a better entry point, your future self is going to thank you for having the discipline to wait. I want to know, what's the next topic you want me to dig into? The Fed, inflation, sector valuations, international markets. What financial topic is affecting your portfolio right now that you can't find a straight answer on? Drop it in the comments. That's what this channel is for. The S&P 500 is at 22 times forward earnings. History says you'll lose money over the next 2 years. The Fed is warning you. The data is warning you. The question is, are you listening?